Okay, in this brief video, we're going to talk through the quiz, the in-class quiz on chapters 2 and 3. So let's get started here. And your quiz may have different order of questions. You all have the same questions, and also the answers might be in a slightly different order. But let's just go ahead and jump in here. You can probably find these without too much difficulty on your little quiz. So the first question, financial institutions. We got a couple of correct answers here. A is correct. Financial institutions do assist surplus economic units and deficit economic units. Financial institutions are an intermediary that brings those two together, so that's true. However, B is also true. Financial institutions analyze and absorb credit risk. So we have this conundrum. We got two correct answers. Or do we? Actually, C is not correct. Neither A nor B is true. That would be bad. But answer D is the one best answer. Both A and B are true. So to get full credit, you needed to choose D. If you chose A or B, you would have gotten half credit for this. In the future, please do pay attention to all the answers. Always look for those all of the above kind of answers. So if you just see the A correct answer right out of the gate, be sure you look and see and make sure that all of the answers aren't correct. And you're always picking the best answer out of the bunch, so make sure you keep that in mind, even if it's not necessarily written in the directions. You always pick the best answer. All right, number 2, the expected inflation rate is 3% and the nominal risk-free rate is 7%. If you have different questions order, you might have different numbers here, but the process is exactly the same. The real rate of interest is going to be the difference between the nominal and the inflation rate. So we're going to take 7%, subtract 3%, and the correct answer would be D, which is 4%. So if you have different numbers there, you're going to take the difference of those, and that would be the correct answer. It seemed like most of the people that missed this were adding them together. That would be incorrect. You would add inflation and the real to get the nominal, but you wouldn't add inflation to the nominal. All right, number 3, the economy is experiencing a severe recession. The Fed will most likely do which of the following? So the Fed wants to, if there's a recessionary environment going on, they want to inject money into the economy or lower interest rates to stimulate activity. So those are the two things that they can kind of do. So let's look at each of these answers real quick. A, increase the discount rate. That would be bad. They wanted lower rates, so that's not correct. Increase the reserve requirement. That's not going to be correct. That would mean banks are going to hold on to more money. C, reduce the dollar amount of reserves at commercial banks. That's not going to help either. But buying treasuries, D is the correct answer. Buying treasuries means that the Fed is going to be pumping money into the economy by buying up assets that are in the economy. So the Fed cash will be injected into the economy, and that will help things out. Number 4, which of the following are traded in money markets? Now, some of these are traded in money markets some of the time, but only one answer is traded all of the time in the money markets, and so that's the best answer. All Treasury securities is incorrect. Some Treasury securities are traded in money markets, but not all. So A is incorrect. B is the correct answer. Bankers' acceptances are always money market instruments. They're always short-term in nature. C, junk bonds. Those aren't really money market. Those are capital market instruments. And then corporate bonds. It would be rare for a corporate bond to be less than a year in maturity. Typically, when you're talking about a bond, it's for a longer period of time. So the only correct answer is going to be B there. Number 5, which of the following risk premiums might be included in a corporation's bonds? Default risk, yes. Inflation risk, yes. Illiquidity risk, yes. So the correct answer is D. Any or all of the above may be included. So the best answer is D. You should have got partial credit if you picked one of the other 3. If you didn't, maybe you can contact me. I'm hoping I graded it that way. So number 6, Fannie and Freddie. This is another one of those all of the above. So every answer is correct. I should rephrase that. A, B, and C are all true statements. The only correct answer is D, all of the above. So again, you would have gotten half credit if you picked one of those other 3 choices. In the future, I'm not unlikely to do that, so I do want you to be careful going forward to only select the best answer. All right, moving on to number 7, common stock. The correct answer is B. It's riskier than preferred stock. That is always and everywhere true. Common stock is generally issued more frequently. There's no there's no comparison there. That's not compared to preferred stock or anything else. So while it is true that common stock is issued, it's not very common that happens. It's not very frequent. It usually happens one time in a company's life at the IPO. So it's not a very common thing to have happen issuing common stock. C is usually less profitable to the investor than preferred stock. That is not true. Over time, common stock should have a higher return than preferred stock because there are more risks associated with it. And so while it's true that you can lose more money with common stock, the potential for gains, and on average you have more gains by investing in common stock than preferred stock. And we're going to talk about that more later as we get into stock and risk and return sort of ideas. And then D is incorrect. Common stock does pay dividends, or it can pay dividends. It would just be further back in line if preferred stock is present. All right, number 8. Maturity date is, the correct answer is when, number C, or answer C, when the principal is repaid or paid. A, several people picked that. That's when the issuer receives the par value. The issuer of the bond is the seller of the bond. So that would be not the maturity date, but the sale date. That's whenever the issuer of the bond receives money. When the coupon payment is first due, that would not be the maturity date. And then D, when a bond is first issued. Yeah, the maturity date is whenever the principal is paid back. So C is the correct answer. Number 9. Each of the following statements is true about pensions except. The correct answer is D, and actually it's the one incorrect statement. So this is one of those questions that sometimes causes problems, and I usually don't like these. I'll try to avoid these, but I can't promise they'll never show up. But as a rule, I don't really love these negative kind of questions. But the one incorrect statement is D. They are backed by the full faith and credit of the government. That is not true. There are entities that can support them, and like insurance companies that can help kick in money, but they're not 100% backed by the federal government. So that is the false statement. The other ones are going to be true, therefore. So A is true. They are a type of savings plan. B is true. They can fail if they're defined benefit plans. So that's possible. There are, again, as I said, there's insurance that can help back that. But if a plan fails and the insurance kicks in, it may not mean that pensioners get back 100% of what they were expecting to get. They can lose money through a company going belly up and their pension plan going bankrupt. And then C is also true. They can be sponsored by a company or the government. So you can have a federal pension, you can have a state pension, or a private company pension. Let's move on to 10. The risk that the issuer of a security may fail to make promised payments to the investor at specified times is, and this one, boy, I don't like this question. In retrospect, I think I accepted both C and D. The answer that's probably the best out of those is default risk, but I think in class I did mention and kind of equate credit risk to default risk. So I would accept both of those answers. I think D is a little bit better answer, but this is not a good question to have two things that are pretty close to each other. So I would have accepted it C or D. Number 11. Junk bonds are, and the definition is B, bonds that are rated below investment grade. Junk bonds are typically not very liquid, so C is not correct, and then D is not correct. They usually have high interest rates, kind of by definition. If they're low investment grade, they're going to have high interest rates. And then finally, life insurance companies are similar to commercial banks, since both, and the correct answer is B, they're both intermediaries. Life insurance companies are intermediaries as well as banks. They often purchase commercial stock. That's not true. Most of the time, banks are buying debt. And life insurance companies, their main investments are also bonds. They get premiums from people and investment from people, and they're buying typically bonds. C, taking money from surplus economic units. That's not true of life insurance companies, really, because if you think about it, when you're buying insurance, it's not necessarily that you have a lot of money extra, it's that you're buying protection. So C is not correct. And then the same thing with D. They don't really provide funds to deficit economic units. That's not really their main purpose. They're providing insurance. So the correct answer there would be B. And that's this quiz. I'm happy to answer any questions via email or otherwise. So I'll see you later.